So lots and lots of stuff going on in markets. Some people think that, October you often get a generational low. We might see a bull market start again. Others think we might be going into 2023 before we get a proper tradable low. I'm going to speak to Kelvin Tay of UBS Wealth Management and get his thoughts of where he thinks we are in the bond market, equities, and that all-important inflation. Kelvin, great to see you. Thanks for coming on the show. And what I wanted to get into on this is really, we've just seen this very impressive kind of move in the Dow over the last month. I think the best in 50 years. We've had a rebound in GDP. In the first two quarters, the slowdown was quite anemic anyway. And we're seeing employment in the US still quite strong. So the question here, I guess, that people start to ask is, are we actually going to get a recession in the US? And if so, when should we think it's going to happen?
Well, I think for this year, the chances of a recession is actually very, very slim. But for next year, I think the odds of a recession happening in the US actually goes up to about 60 to 65%. And that's the market actually putting its odds on a recession happening in the US. But nonetheless, even if you don't have a recession next year in the US, the conditions, the situation next year will pretty much feel like you're in a recession. You probably have the unemployment rate rising, and we think it's going to hit about 4% by the end of next year. You will have a tightening of liquidity situation. We think that the terminal rate for the Federal Reserve is going to hit about 5% by the end of the first quarter of next year. And the bond yields will remain prohibitively high at about 4%. So when you combine those factors together, even if you don't have a recession by definition, the conditions will suddenly feel like you're really in an economic slowdown.
And is that because, what we've seen in some ways already this year is that whilst we haven't been necessarily in a classic defined recession, it's actually, we probably have seen a recession in some small businesses and in maybe the median household in the US. And is it going to continue because I'm guessing inflation will remain slightly stickier, that it's still going to be a problem for that cost of living crisis?
Absolutely. Talking about that, if you look at core inflation, which is what we are obsessed about, right? Core inflation has been very, very strong. And in fact, in the last couple of months, it has actually been rising. Right now, it is at about 6.2%, which is way above the Federal Reserve's target of about 2%. Now, if you go back to the 1970s and 1980s, Paul Volcker, when he was the Fed chairman, raised rates up to about 20%. And despite that, it took a while for inflation to come off. And even when it came off to about 4% only. And that's only when the unemployment rate was at about 10.5%. So we're very far from the kind of situation at the moment. So I do think that where the Federal Reserve is concerned, it has some more room for hikes to actually continue. And if you're talking about the markets and why are they, suddenly, rebounding so quickly, like, you said earlier that the Dow Jones has had its best month in the last 50 years, it is largely because the market is actually hopeful that in the event of an economic slowdown, that the Federal Reserve will perhaps actually start to slow down or perhaps even stop hiking at the moment. I don't think that's going to happen. If you have to put inflation together with slowing growth and you have to ask yourself, which one is the priority? Inflation is certainly the priority, because if you have very high inflation, that's going to eat away into your returns where growth is concerned, no matter how high growth is, right? And it's just going to exacerbate the situation. So the Federal Reserve will have no choice but to make sure that inflation comes down to its target first. And as I've said before, it took a long time for Paul Volcker to bring inflation down. And I don't think it's any different this time around.
And in terms of that, where we could see inflation going, do you think that inflation will rebase to a higher level? Do you think that the central banks in general, not just the US, but generally will eventually accept a higher base level of inflation? But do you still think it takes a long time to get to those sorts of levels?
Absolutely. One of the key differences between inflation now and inflation in the late 70s and early 80s is that now it's pretty much multifaceted, and it's the labor market that's actually driving it. I'm sure you know that in the US and in Europe in particular, the baby boomers are now starting to retire, which means that you have a smaller working age population. And of course, when you have a smaller working age population, that can only mean one thing, that your wages will rise. And wages is a very, very big determinant of that. So unless you can actually somehow engineer a huge growth in the working age population overnight, inflation is going to remain quite sticky. So I think in the next 12 to 18 months, policymakers will have no choice but to actually rethink the assumptions for inflation. And perhaps one of those assumptions will be that it may not necessarily be at 2%. In fact, it could actually be at 3%. Now, another point to note is that we've been fortunate this year that China is in an economic slowdown. Can you imagine what the demand for oil and gas would be, and where oil and gas prices would be like if China was actually growing at 5.5%? it will be stratospheric, right? And inflation will on a headline basis will be a disaster for all of us if that was the case actually.
So with that, I mean, there have been these rumours today. This is Tuesday, where we've been hearing sort of comments that maybe China is preparing itself to open up. Now, there's two elements to that. One is obviously there will be demand for particularly energy. Will there be, on the other side of that, an opportunity to maybe unlock some of the supply chain issues that have been a problem over the last 18 to 24 months? So will it be two-sided? But I guess, is energy the one that really matters in this equation?
Yeah, I think it's two sides to the coin actually. Um, China opening up will mean a greater demand for oil and gas, and China basically buys a lot of its oil from the Middle East as well as from Russia, oil and gas. Um, if that's the case, that means that they're actually competing with all of us for oil and gas, right? Because the Europeans are no longer buying from Russia; they have to buy from the Middle East as well. And likewise, myself in Singapore government actually buys from the Middle East too. So the demand for Middle Eastern oil is just going to go sky high, which means that the gap between WTI and Brent will actually widen even more from here. Now, the flip side is, like you rightly pointed out, the supply chain issues will be largely resolved, and if they're largely resolved, that in turn actually helps inflation. But I would point out that the difference between now and before is that it's basically the labor market that is responsible for most of the increase in price, not on the global supply chain side. I think the supply chain side has actually eased quite dramatically in the last 6 months. But on the supply of labor front, that still remains very, very intense. Unless we can increase our productivity overnight or we get more working age people coming to the market, those issues are not likely to be resolved overnight. It's a structural issue in that sense. But of course, with China opening up, that means that demand will be better, will be stronger. And if that's the case, perhaps the world might actually avert a technical recession next year. But you know what? I'm not putting my money on that one, actually.
And on that sort of equation, a lot of people have sort of said that the power is still with the corporates. And in fact, some people have said that one of the problems for inflation that we've seen is that corporates have been putting higher prices through. It's not been the unions this time, even though wages are going up. And in fact, prices have been pushed through at a faster pace than wage increases. So margins for a lot of particularly old world companies have remained relatively wide. Do you think that's the problem? And if corporates do have that power, and in the US, people have said there's too little competition rather than too much, too little capitalism. Do you think that's another reason why the Fed will have to kind of almost still beat down on these big corporates so they eventually stop passing these higher prices through to consumers?
You're absolutely right. I mean, that is a great point. If you look at the world in the last 20 years, right, we have actually been gearing towards big mega corporates. And these guys have pricing power. So no matter how high the wages go up, they can actually increase the price of the goods and services, and we have no choice. We have to suck it up, right? I mean, if you don't use WhatsApp, what can you use in the UK? Tough choice there, right? I mean, just as an example, not 100% applicable, but you know what I mean in that sense. So we're now being dominated by a lot of these mega companies, and that's not healthy. It is in fact a problem with capitalism. Instead of engineering, instead of the free market engineering more competition, competition has actually become less intense, and therefore these guys have a lot more pricing power. And that's, again, another reason why prices are being very, very sticky.
And so just adding sort of all this together, but really looking at maybe just the two biggest markets out there, very tricky to time all this, but in this framework, let's look at equities. Should we still think that equities will be volatile into next year? Because it's when you see unemployment pick up and potentially households liquidating, some of their holdings and 401k flows slowing down. Is that when we should be looking at probably the big bottom in the market and sometime maybe into next year?
I think the equities market is going to be very weak for quite some time for two reasons. Firstly, where the S&P 500 is concerned, about 30% of its earnings is actually derived from overseas. So with the dollar being so strong, that's going to hurt the earnings of these companies, right? So that's the first negative. The second negative is that when you have rates at about 5%, assuming that it peaks at 5%, your earnings growth is going to be affected. So we're looking at an earnings growth of about $2 per share, 2% for 2023 for a lot of the corporates there. And that, to me, is actually on a high range. We haven't talked about quantitative tightening. If quantitative tightening comes in a bigger way, your yields go up to about 4.5% where the 10-year treasury is concerned. That is going to be expensive for a lot of the corporates to actually refinance where the bonds market is concerned, right? So when you put all that together, that only tells me that earnings growth next year in the S&P 500 will be quite weak. And that in turn means that you're not going to see a re-rating of the equities market, because even though the S&P has actually rebounded in the last 2 weeks, It is trading at about 17 and a half times earnings, which is still expensive. The 20-year historical average is 15 times. And why am I looking at 20 years? I have to look at 20 years because the 20-year average is a period where you had very high interest rates and very low interest rates as well. Looking at it on a 5 to 10-year basis is not going to tell you the full picture. So 20 years is actually a more accurate reflection of the valuations. And if you compare it to the 20-year valuations, the S&P is actually expensive. So what does that tell me? It tells me that there is room for the equity markets to actually come off.
And then finally, sort of the bond market is this one where we're always trying to work out, when a yield's going to peak and which part of the curve should start to come back first. Do you think that this is the Fed will eventually sort of, because of this inflation being sticky, will stay sticky at the front end, but eventually back end should start saying, yeah, growth slowing, and therefore those back end yields should come down before the front end? Is that how you'd play that?
Yeah, I think you're absolutely right. At this point in time, it's the short end of the curve that's actually doing really, really well in terms of the yields going up because of the fact that, Fed fund increases of interest rates always affect the front end of the curve first. But I think over the medium term basis, and I'm talking about 6 months here, when the economy really starts to slow down, unemployment rates start to rise, then I think bond investors will have no choice but to take a longer term outlook and basically seek shelter in the, in I would say anywhere between the 5 to 10 years in that sense. Then you'll start to see the 10-year actually, bond yields actually sliding and the bond prices going up. So even at this point in time, I would actually be tempted to actually put, let's say if I want to invest $100 into the US Treasuries market, right? I would actually now start with at least 30% in the 10 years and probably gradually build that up towards the end of the first quarter of next year.
So basically on what you're saying there is there's still room for another shock potentially from CPI, from inflation, but even if we get that sort of shock, the reaction function from the central bank, from the Fed, is such that it will drive a slowdown in 2023, which will cause a reaction from the back end of the curve.
Absolutely. To me, the Federal Reserve has no choice but to actually induce a recession, to actually slow the employment market. And it's clear. It's like when some patients have a head injury or coma, the doctors, what they do is, if you have swelling of the brain, they try to induce you into a coma so that you can actually rest, so that the swelling of the brain goes down before they take you out of the coma. This is the exact situation we have. Now, one point that I forgot to make earlier on with regards to inflation is, why is the labor market in the US so tight? It is not just the demographics. Back in 2008, when the global financial crisis actually happened, the baby boomers couldn't afford to retire because their pensions, which were stuck in the 401k, collapsed. And on top of that, the housing market collapsed as well. So they had negative equity if you look at the balance sheet. When 2020 actually happened, the Federal Reserve and the US government stimulated in a massive way. Equity markets recovered, bond markets recovered, and on top of that, the housing prices actually recovered. The average price of a median house in the US back in December 2019 was about 300,000 US. That same house is going for 428,000 today. Now, you tell me, is there any reason why the baby boomer would not retire? Don't forget that demographic is most vulnerable to the COVID-19 pandemic as well. And on top of that, the vaccination rates amongst the demographic is also amongst the lowest in the US. So these guys actually leaving the market and they're not coming back because they're getting older. And it's going to be very hard to persuade them to actually come back into the market. So that's one of the reasons why the US is actually short of workers at this point in time. Plus the tighter immigration policies in 2016 introduced by Donald Trump at the point in time. And that's it. You put the two together, labor market is extremely tight. So you need to induce a recession to bring the demand for labor down, unless you can actually overnight increase your productivity, which is almost impossible.
Brilliant. So 2023 looks like it could be yet another interesting year. We've had a couple of them on the trot now, but another tricky one to navigate.
I think it's going to be hard. I think it's going to be challenging. And to be honest with you, I think this year is probably more challenging than 2008. In 2008, at least the bond market was actually breathing. This year, it has been completely suffocating. Everything is down. And you can't escape it because of the fact that you have high inflation, so interest rates are high. When interest rates go from this level to this level in a very short period of time, nothing survives in that sense. So we're all being suffocated here. Hopefully next year will be a little bit better. We can actually breathe a little bit better, but it doesn't mean that we're all likely to actually go out and be screaming for joy where the market's concerned. I think it's going to be a little bit of a downer where that is concerned.
Well, Kelvin, that's great. Thanks very much for that, and good to speak to you.
Thank you very much, and I'll see you next time.
So as you can see there, Kelvin thinks that inflation remains the key. Yes, it should come down, but it will remain relatively sticky, probably at higher levels, with the risk that if China comes back on board, some of these energy prices may get yet another boost. And with that in mind, and with the tightness in the employment market, it looks like the Fed may have to keep going. You know, we always look at this on a meeting-to-meeting basis, but when you look at it on that 12-month view, employment is still relatively tight. Prices at this moment in time are still high. And there is still a lot of work to do in terms of taming that inflation, which potentially suggests that equity markets are really a story for bottoming in 2023.